Why doesn't somebody tell me what they think is going on here?
Brent, welcome back to another fantastic midweek update on another fantastic week in the markets. Now, it is a Wednesday afternoon. The big hype, the big drama, the big chatter is the recent downgrade by Fitch of the U.S. credit rating. I know everybody wants to hear our take on this, but it's too fresh of a topic. We need to let this simmer. We need to let the haters chew on it. Tell us how exactly this is going to turn into the end of the dollar and the end of life as we know it. So we're going to hold off on that. We're going to put that in the cooler,
Okay.
in the ice chest, and save that for a weekend barbecue conversation. But what is interesting, and we did highlight over the weekend and in the Monday peak of the week, is that we have a pretty busy set of data coming out all week long. But one of the big ones, because everyone's waiting for the world to end, even yourself, you've been net short, you're kind of waiting to see this pullback, and it just isn't happening. And inflation feels more and more anchored, and that more and more emboldens Powell to keep hiking. This week, we've seen a lot of manufacturing data coming out, and anyone who is trying to look at data or use charts to predict a recession, ISM, the manufacturing indexes, tend to be one of those indicators that they hang on to. And once it falls under 50, it's a flashing red: recession, recession, recession. Some of these things have been in that recession territory for a while. However, it's the recession is eluding all of the bears for some time now. The one component that everyone keeps hanging on to as to why they've been wrong so far is that, employment. You just watch, especially in housing. Everyone's like, oh, you just wait. Once housing or once employment rolls over, it's over. Game over. This is going to be, the worst recession we've seen in years. It's going to be a depression. But although employment in the manufacturing sector is also rolling over and is in deep recession territory, we are at a 2-year low in job openings. So the labor market is still tight. None of this really says inflation is going anywhere or that, we're about to hit a brick wall all of a sudden. So what is your take on some of the data so far this week and some of the narratives I just kind of rolled out there for you?
Well, as you mentioned, we knew this was going to be a very data-heavy week, and so far the data. It's funny that I feel like there is if you are trying to find something in the data, there's something in there for everybody, right? Like it is rolling over. Like data is coming down. If you look at where we were a year ago to where we are now, inflationary pressures are coming down. Now, are they low? No, but are they trending in that direction? Yes, and are these manufacturing numbers coming down? Yes. And, so there's plenty of, charts out there that you can find to confirm your view that the recession is very close and it's just a matter of time. But then to your point, the job openings are the labor market's tight. The earnings are staying strong. And those are two of the biggest things that Powell is worried about. And again, Powell is deathly afraid of becoming another Arthur Burns, right? And he does not want that to be his legacy. And so while I think that his whole thing of, we're slowing, but we're not stopping and we stay resolute, I think that is the right policy to take. And he maybe shouldn't even, if you just look strictly at the data, maybe he shouldn't have tightened this last month and maybe he shouldn't do it again, but he did, right? And so, and I think until we get some, until the numbers start to point one way or the other, and there's not something for everybody, and it becomes more clear, then we're not going to have clarity. And so, the market is pulled back a little bit today. I know the bears are very happy today because I don't even think the market's down 1%, but all the bears seem to be happy because at least it's not going up another percent today. And there's still a lot of data left to come. Over the next couple of days, there's a couple more pieces that have come out, and non-farm payrolls is always big. So, I can't remember if we've talked about this, but what has been really quintessentially historically accurate and playing out again this year, but is but people are trying to figure out why it is this run up in equities heading into a recession, right? If we're getting into this recession. And the fact is that historically, whenever the yield curve inverts, and the yield curve first inverted 18 months ago or 15, 16 months ago, and then it did again about a year ago, whenever the yield curve inverts, it always leads to a recession. Now, it depends on what the length of time is. Sometimes it's 9 months, sometimes it's 36 months, but it always happens. But what also happens during that time frame, or almost always happens, that nobody ever talks about, all they ever say is it's going to cause a recession, is that equities almost always rally during that lag. And so that's exactly what we've had. We have had the yield curve inversion. We've had the data starting to soften. And yet, despite that, we've had equities rally, just like they always historically have. But I think the reason it gets really interesting right now is, number one, we're heading, Powell has indicated we're getting close to the end. Everybody's anticipating the end. They've front ran the end. And now we're going to have to wait and see whether the end is actually here or not. And it'll be interesting to see what equities do as a result. So anyway, that's just a long way of rambling about your question. I hope that's what you wanted.
Yeah, I want to be clear for everybody too. Look, we're doing a number of videos a week. We take a little bit more time on the weekends. This one's going to probably be under 10 minutes. You referenced the yield curve. You referenced this lag. You talked about how equities kind of perform. We're not going to get into every little explanation, definition of yield curves and what always happens and sometimes happens. So, take this as just a general kind of scope of what we're seeing this week with the data, some of the things that we've talked about and how it kind of intertwines with these topics. We're not here to get into a debate about every little nuance of the yield curve. So take some of these comments with a grain of salt. And with that being said, one of the things that's kind of been interesting to me, I mean, the last couple episodes, but specifically this last weekend, you address the fact of where you kind of got some of this wrong, but the way you played that view of a potential correction was with options. So you only really had the impact of the cost of the premium. And there's a popular term right now, because the data is not really clear and everyone's trying to fight or jockey for position as to who is right. A lot of people refer to a over bearishness as someone projecting fear porn, right? And I would say that's that's the last thing that we have done in any of our conversations. Having a bearish framework or a bearish view is just that, it's a view. It doesn't mean we're, you particularly out there trying to sell that bearish narrative. But one of the things I saw today, the other thing that's really classic to me is the loudest people are always the anonymous ones. And this is especially true with this hyper bearish sentiment. And some of the stuff I saw today about housing market specifically, like this is going to happen, and then this, and this, and it's going to be the depression. It's going to be the worst thing ever. And, you look back at, this week, there was some information or conversation around consumer debt and, the highest numbers in terms of credit card debt. And I think nominally you can get lost in those numbers, but what does it really mean in relation to credit limits or how much purchasing power that credit actually has? Of course, credit, even government debt's going to keep going up, but ultimately, in relative terms, what story is that really telling you? And, I understand credit card interest rates are high, and eventually you're going to see some defaults and default rates slowly starting to tick up. We had a banking crisis earlier this year. Seems like they've plugged that hole with the Bank Term Funding Program. Again, to preface you've said a gazillion times, understand that it's not how much firepower they use, but how big of the fire or how big of a hole they're trying to plug. So I guess the point I'm going to make here, and I want your comment on it, is I know this is going to upset and frustrate people, but it doesn't always go up. But when it starts to go down, it doesn't need to sink like an anchor, and the whole world doesn't need to implode. And when you have economics, when the economy starts to slow and you have contraction, things are going to break, and you're going to have businesses fail, and you're going to have people go into default. Just because you have some of that happening doesn't mean everything's going to suddenly follow suit into a downward tailspin. So I don't know what kind of comment you want to add to that.
Well, I think the best comment to have is, I think when people see that start to happen, they extrapolate it linearly, and they think that it's destined to play out because that's what would happen in a free market. But, I've said this a million times, is we do not live in a free market. We are not going to have a situation where bankruptcies continue to rise at a rapid pace and the government doesn't respond to it, right? I don't know how they will respond to it, but they will. And will it be successful? I don't know. Maybe it will be, maybe it won't be. But it goes back to our there's a hole and they're trying to fill it comment, right? Typically, when the governments come out and they try to fill the hole, they don't really know how big the hole is. So they don't overdo it initially. They typically, try to throw some dirt in there and see if that fills it. And when it doesn't, then they throw some more dirt. But it's very rarely that they come out and they throw more dirt than necessary, and now you don't have a hill, but you have a mountain, right? And so, and this is why I'm not in this, we're going to have a crash and a Great Depression camp. I don't rule it out. I understand exactly why it could happen, but, there will be a reaction if the data that is starting to weaken continues to weaken and roll over. There will at some point be a government reaction or a monetary authority reaction. And you kind of have to wait and see what that reaction is before you then extrapolate those lines in the same direction, or whether you think it's enough to make them turn.
Excellent. So I think there's enough bait there for the bears and everyone else to salivate over and chew on until our weekend episode. It's going to be a fun one. This past week we had our best numbers ever on the weekend episode. So hopefully all those people who joined in for the first time will join us again this weekend. I think we've got a lot of fun, are headed our way with this downgrade, which we mentioned. But anyone who's new to the show, this is our midweek update. You can visit Milkshakes Pod, which is our handle on the YouTube channel. And you can see we have a number of playlists, the full episodes. We do our peak of the week on Monday. So all that information's there. You can also learn more at milkshakespod.com. If you want to interact, yell at Brent, tell him why he's wrong, and share your feedback or views on why the world is coming to an end, you can do that on Twitter with Brent's handle at Santiago AU Fund. You can find me at John Kutsmita, and that will do it for our midweek update. Thanks, everybody, for joining us. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.